Hello there, everyone, and welcome to the Final Bar. It's Tuesday, August 13th, and I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com in a sunny and beautiful Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the best practices of technical analysis. The market having another decent recovery day. NASDAQ, technology all up in a big way. The NASDAQ up about 2.5%. Technology shares moving over 3% higher. NVIDIA continuing to push to a new swing high. And Meta close to making a new 52-week high. It felt like that was an impossible threshold that these mega cap growth stocks would never reach again. It's probably a little ridiculous of a statement to share, but certainly you're seeing that recovery, generally speaking, in the growth space. Let's get to our market recap and see what happened today on this nice upside recovery day for the NASDAQ with the inflation data impressing investors. The S&P 500 finishing up 1.7% to 5434. And as I just alluded to, right, you had the PPI number before the open today. The CPI comes out on Wednesday. And, generally speaking, CPI is a little more widely followed and generally assumed to be a little more meaningful. But the PPI number basically came in a little under what was expected. So, again, sort of back to that, what the Fed has been doing is kind of okay. We're sort of back to things are probably going to be an easy transition into a Fed rate cut cycle. We'll see. But for now, the S&P moving higher by about 90 points. The NASDAQ Composite moving higher 2.4%. The NASDAQ 100 up 2.5%. Mid caps, small caps all feeling the love as well. The S&P 600 small cap index was up 1.7%. The only thing down on that front page is the VIX, which did manage to go back below 20. We're actually 2.5 VIX points below where we were after Monday's close. So we're down around 18. It's interesting, how quickly the evidence has fluctuated from, a clear, resounding uptrend driven by mega cap growth in May, June, into early July. A market in complete mayhem, right? Completely dislocated with the mega cap growth stocks puking it out and leading the way lower in mid-July to early August. Now, all of a sudden, over the last 5 trading sessions, we've seen a nice bounce higher, enough from the VIX to go above 60 to below 20 in about a week. These are volatile times, my friends, and I would say I still count me very skeptical that, we are part of a broad recovery, because a recovery August into September would pretty much fight against a seasonal tendency that has been pretty consistent here in recent years. I'm inclined to assume that that's going to take hold, and that the recovery is still a little way off in terms of a full recovery to a full-on bull market phase. But we'll see. The charts, the proof is in the charts. Let's continue to track them. The TLT bond price is moving higher. So as we have not really seen, we've seen bonds rally while stocks have been struggling. Now we're actually seeing stocks and bonds rally together, although stocks certainly doing much better today. But note that with bond prices going higher, that means interest rates are coming down. The 10-year yield down around 3.85, the 5-year point below 3.7%. The long bond yields just below 4.2%. Now we're starting to get more and more of a flatter yield curve as you see the shorter end remaining kind of elevated. That's not true. We're actually getting more of an inverted yield curve. That's how the math works, David. With the short end coming down a bit, but the long end coming down a lot more. So we continue to have that inverted yield curve for now. The dollar index down about 0.5%. That's using the UUP ETF. Commodities pretty much all in the red today. Gold and silver down slightly. We talked about the remarkable strength in the precious metals trade. Yesterday I had a conversation with Michael Guyot about precious metals, gold and silver, among a lot of other really fun topics. You can find that conversation on my YouTube channel called Market Misbehavior. We went through a number of different topics yesterday on a live stream, but talked about precious metals. And again, I think the long-term story for commodities is still very real. The long-term base case for precious metals is very meaningful, assuming that there is a need for a safe haven. I think one of the great benefits of something like gold, the low correlation to stocks, and what we call a differentiated return profile. Meaning it tends to do something very different than the S&P or the Qs. So if you're concerned about further downside in the major equity averages, gold can often be an interesting place to diversify. Down slightly today in the rest of the commodity space, down a little more. Energy ended up being the worst S&P sector today. Bitcoin continuing to find renewed life. We're back above 60,000 here in the last 24 hours. Currently trading just below 61,000 as we're doing the show today. But overall, Bitcoin is in a general pattern of lower highs and lower lows. We've looked at that chart before. We'll get to it time permitting here as we continue our market recap. Look at the 11 S&P sectors, and you can see its growth at the top. These are your FANG sectors back at the top of the leaderboard. It's been a while, fellas, but good to see you back up here. The XLK, number one, up over 3% today. Consumer discretionary, the XLY, up 2.5%. Communications services, up 1.3%. On the downside, only one of the 11 S&P sectors actually finished in the red. That was the energy sector, down 1%. Consumer staples and utilities, both up slightly from yesterday's close. Looking down to the Magnificent Seven and Friends, some interesting developments here. I think one of the big themes we've been, really focusing on here over the last month, really, right from mid-July, the market peaked to now mid-August with a, potential tradable low here and a nice bounce over the of the subsequent week. The story has been growth stocks really taking a back seat to value leadership, things like industrials and materials, at times energy, and defensive sectors like utilities, real estate, and consumer staples. Today, you're seeing a move completely against that. We're back to sort of the May-June sort of feel, where stocks like NVIDIA and Meta and Amazon are just having really strong up moves, and the other stuff is lagging behind. That's kind of what today was like, sort of a bit of a throwback. NVIDIA up 6.5% today. Tesla up 5.25%. On the downside, the worst performer of this group of 8 leading growth names was Alphabet, which is only up 1.2%. So the growth trade working in a big way today. Now, again, the ratio of growth versus value still has very much been favoring value. This is a one-day move, but very much something I would, for sure will continue to monitor and think about and reflect on. Looking to the daily chart of the S&P 500, here's where we're at. I drew these big, thick red lines, I think, on yesterday's show. I kept them on the chart here just to show, and this is sort of your, buyable dip tracker, for lack of a better term, right? These thick red lines show you the major corrections from the end of 2023, from spring of 2024, and now summer of 2024. In the previous two observations, we did have a short-term pattern of lower highs and lower lows. So the question is, what told you that corrective pattern was done? What gives you the confidence to ride a new leg higher and assume that there's further upside to be had and it's not just a counter trend bounce? I think what differentiates a dead cat bounce, which we've been describing the last week as being, versus something of a buyable dip, is what happens soon after that, right? They look very, very similar at the initial rally, but what happens with a dead cat bounce is you immediately make a lower high, and then you start the next tactical leg lower, right? That's sort of the indication that we're not quite done with this corrective phase. The opposite happened in November of last year, where we broke above trendline resistance above the 50-day. We started to make a new swing high. We saw that here in April with a swing above trendline resistance above the 50-day moving average. We made a new high above the March peak. Those are the three things I would be looking for here. And if we get a repeat of what we saw in May or in November of last year, I would be inclined to label this as we're having an unusual but very real recovery. So get above the 50-day. We've not quite done that. Get above the trendline resistance. We've not quite done that. Make a new swing high. Get above 55, 50 and change. We do all those three things. I'm going to struggle calling this a correction anymore. But for now, I still think of this market as guilty until proven innocent. Now, tomorrow, again, we have the CPI number coming out before the open. Today's PPI number, certainly, caused a lot of renewed optimism here. Growth stocks back up. We're sort of back to this Fed's got it all under control here. How quickly that narrative has changed from the Fed's got it in June and early July to the Fed's an absolute disaster, behind the curve, doesn't know what they're doing, nothing's going to work, which was mid-July to early August. Now all of a sudden we're back to, the Fed's going to be able to cut rates and have this Goldilocks scenario here. It's hard to keep up with the fickle nature of this market, but that is what the S&P and the NASDAQ in 2024 appear to be about. Do want to show you quickly the chart of the VIX here. Let's look at a couple other macro charts, and we'll look at some individual stocks on the move. The VIX, of course, spiked on an intraday basis above 65 for only the third time since the financial crisis. You can see we're now back below 20. Again, I'm still very uncomfortable with the movement and volatility. I don't think we have a good explanation. As a matter of fact, I had a number of people that have written me asking whether it was an accurate print, and all I can say is that's what the data is confirmed. We've confirmed it from our data providers. Looking at other platforms, we're all sort of showing that move of the VIX above 65. So I think that indeed happened. Now, the reason why that sort of spike happened and whether it means the same that it has in previous major corrections is still an open question. For now, every day that the VIX remains below 20, for me, makes me a lot less concerned about potential downside because big downside moves happen on elevated volatility almost all the time, right? So if the VIX is able to stay below 20, the more that that's the case, the less concerned you have to be. And I think that's what probably gave you confidence in November and December of last year because we popped above 20. But then we got below there, and then the VIX kept trending downwards. And this is before we'd even made a new swing high, getting above that July peak. We were just rallying on lower volatility, and that certainly feels like we're in pretty good shape, right? I mean, the longer we spend below that level, and as a matter of fact, we got below 15 again. So we'll see if that sort of continued decline in the VIX would happen. That would certainly make me a little more optimistic than I've been here. But again, keep an eye on the CPI number tomorrow. Could be a big game changer here. In terms of breadth, we haven't talked a lot about breadth because, to be honest with you, the breadth has been okay. Now, if you look at what's happened, we're back to that sort of contrarian relationship where the market has generally gone up since the April low. The market has, generally speaking, had upswings on weaker breadth and has had downswings on stronger breadth. And what I mean by that is look at the July, mid to late July. Look at how the advanced decline line in the New York Stock Exchange actually made a new high the last week in July, even though the S&P itself was actually trending lower. The Qs were actually trending lower by that point. So you had a divergence with higher highs in breadth but lower peaks in price. Now, that's usually a concerning sign. Now, in the month of August, we've had a quick turnaround. We've had a nice spike higher in the S&P and the NASDAQ, but look at how all the AD lines are actually trending lower. So you have the opposite sort of this inverse relationship with the market moving higher on weaker breadth, the market moving lower on stronger breadth. And to me, that is a leadership thing, right? The reason why that makes sense is because while we think about breadth and price action moving together, which I don't blame you because that's the traditional relationship, markets tend to move higher on stronger breadth. They tend to move lower on weaker breadth. But that's flipped right now. That narrative is flipped, and it's because of the leadership, right? The indexes, the S&P and the NASDAQ, are going up when the mega cap growth stocks like NVIDIA are having days like they did today. When Meta is threatening a new all-time high, that's when the S&P and the NASDAQ are going up. It's not when a bunch of industrial and materials and REITs are going up. That's sort of counterintuitive. So when people rotate into the mega cap growth trade, the indexes go up. Breadth is overall trending downwards because they're rotating probably away from a lot of those names and getting back into the big winners, right? The leading growth names. So breadth overall not particularly strong in August. I hesitate to call that a bad thing because it hasn't been a bad thing for much of 2024. The market has shown that it can rally on weaker breadth conditions, particularly in June and July. So for now, we're sort of back to that relationship. Looking at the interest rate environment, again, we talked a little bit about this yesterday, so I don't want to go too much into it, but just to point out that yet again, bond prices continue to rally, even though stocks are going back up, as defined by the S&P and the NASDAQ. The TLT, the AG, are also going up as well still, right? So we've had bond prices trending higher. That means rates are trending lower. And again, the good news for that is that general movement tends to make things less expensive for consumers and for businesses, anyone that needs to borrow money, and that tends to spur economic growth, right? So the argument for the Fed lowering rates, the argument that the 10-year yield continues to go down, is that's generally going to make things more affordable, less expensive for people and businesses to borrow. That probably spurs spending and economic growth. That's what leads the economy to grow going forward. So what's happening now is the market pricing in that scenario where the rate cuts are working and where inflation has come down to reasonable levels or will continue to come down to reasonable levels. We'll see. Next Fed meeting now about a month away from this week. One chart I just want to show you just to illustrate a very interesting phenomenon. Where did I put this? Let's see. I think it was here. I think I called it some horrible name like SPY something. Here we go. Yep, there it is. Horrible name. Bunch of tickers, year-to-date returns. Here we go. Did you know between gold, the S&P, the NASDAQ, And the equal-weighted S&P, your top performer year to date, is back to gold. And actually, that's been the case through the month of August here. Gold, the GLD, is up 19% year to date. The S&P 500 with this last rally here over the last week or so up about 15% year to date. The NASDAQ 100 up over 13%. The equal-weighted S&P only up about 7%. So owning gold over stocks has been a remarkably good play so far in 2024. I find that very counterintuitive when you think about the fact that stocks are up to the degree that they are. But just note that when stocks pulled back in July, that's when gold really started to accelerate to the upside. Gold is sort of back to being a safe haven of sorts. We're seeing that traditional inverse relationship going into the April market low, going into the August market low. So if you're thinking this is a counter trend rally and that stocks have at least another leg down, the relationship in 2024 has been a beautiful inverse relationship between stocks and gold. So lower stocks would probably mean better gold. What's interesting is in the last week or so, gold and stocks have all been going up. It's sort of the everything but the dollar rally, I guess, is what I would call it here in August of 2024. All right, to finish off, let's look at some individual names. I do want to start with the chart of NVIDIA, and actually, let's go here. So you have some of the Magnificent Seven stocks doing quite well today. Here's NVIDIA up 6.5% today. Nice up day. Again, it looks a lot like the chart of the S&P, like the chart of the NASDAQ. I think what was really interesting at the end of July is when NVIDIA posted that bearish engulfing pattern just as it's touching to the penny the 200-day moving average. So this is a stock that has had a series of bearish engulfing patterns at the June peak, at this July peak, in late July. Every one of those times, a lower peak or a peak that is defined by a bearish engulfing pattern. And the candle chart makes that pattern really obvious. It's where you have an up day and a down day. Day two's body, the open to close range, engulfs day one's body, and that's that beautiful bearish engulfing pattern testing the 200-day moving average, suggesting short-term weakness. Now, to be honest with you, candle patterns like that are really only designed to tell you about the next 1 to 3 bars. They're really not designed to be any longer term of a forecasting tool. In my own experience and in talking with other experts in the industry, I do want to note the symmetry on the chart of NVIDIA, though. Look at this right here, where you see how the S&P, this is NVIDIA, made a peak in March. There's another bearish engulfing pattern. That lined up with the peak in late March. That's the gap also in mid-May. We can find that lines up pretty well with the lows that we've experienced here in early August. And $100 a share is right there as well. It's also a 61.8% retracement of this April to June rally. So if this does end up being a significant low for NVIDIA, I would argue this is the most clear-cut technical, what we'd call a confluence of support, which is multiple indicators, multiple approaches, all sort of coalescing at a very similar level. And so I think NVIDIA above $100 is a pretty decent chart here. What's interesting is if you draw a trend line from the recent highs, we're starting to break above trend line resistance, particularly this last one. If you draw it from the July peak and the mid-July peak and kind of cuts just under this bearish engulfing pattern, you can see we're now breaking above it with the nice move higher, 6.5% today. So charts like NVIDIA are not that bad. I would say they're not great yet, right? And it's not like we're making higher lows or higher highs. Right? We have to get above 120 to get above that late July peak and to get back above the 50-day moving average. I think that would complete a bit of a bullish rotation, and for me, suggest a return back to those previous peaks around 140. But that's an if. That's an if we get above 120. So keep an eye on that. That's a great place, by the way, to set an alert on the Stockcharts platform. I'm actually making a note to do that as soon as we're done with the show. Why don't I show you how to do it while we're all here together? No problem. A couple different ways we can do it, but what I like to do, that's not it. What I like to do is go down here to more tools, create alert. And then I can say, actually, hold on. Let's go up here so I can see the levels again. That's smart. All right, more tools, create alert. We're going to say NVIDIA crosses above. I'm going to say 120. And I'm going to say, Keller, NVIDIA broke out. And I'll select each of these, save alert. I was going to say one of the best parts of being a Stockcharts member, I would argue the scans, the alerts, being able to have a platform like Stockcharts do some of the work for you. So I am not great about thinking of a level like that and just keeping monitoring it on my own. I have a horrible memory, which is why I use paper planners and I use electronic websites like Asana and others, and why I use alerts on the Stockcharts platform. As soon as I see it, I make a note, I make an alert, and then the platform tells me when I need to be aware of something happening. All right, let's keep going here. MPWR in that same group, semiconductors, close to making a new 52-week high. I would have to get above, well, we'll call it 875 or so to get above that July peak. But I'm starting to see this as a bit of a, what's called, probably call it a flag pattern, which is where you have this move here. Whoops, let's go to this. I'm going to make a parallel line and draw it down here. I mean, it's not perfect, right? I mean, the pattern is really more like that. It's more like a bit of I don't know what I'd call that pattern. I'd probably fudge it and draw the line here, although that's not something that we probably want to say. You know, I don't know if I would draw it as a perfect flag pattern, but I would say drawing a trend line off of the peaks, I don't have a problem with that. And we get above it today here. So we're starting to find that more and more. And I think that is one of the things that would tell you, as you're looking at this market, I think there have been clear signs of distribution, all the things we've been talking about here recently, but you always have to think about what would tell you that things are just not that bad. Some of these stocks breaking above those trend lines is pretty meaningful. That's why I have a trend line on the S&P, that big red line that we looked at on the first chart in today's episode. I think with charts like MPWR and NVIDIA and others, we start breaking those trend lines, it just tells you maybe things are not as bad as we originally thought. Let's keep monitoring them and see if they can make new swing highs, see if they can make higher lows. That's where the change is really made. But for now, pretty interesting. StarBucks, of course, big news today with the new CEO. Market taking very kindly to that, up about 25% today. And had a question earlier on social media. Are charts even meaningful when it's something like Starbucks with the sudden news and gapping higher? I would argue any sort of financial analysis is not particularly equipped to help you anticipate a change in the CEO, right? I mean, that is something that is more of a structural change in the company. I don't think that's something that is implicit in a price chart. It's certainly not implicit in a financial statement or any sort of fundamental factors or quantitative factors. That's one of those one-off things. That's what arguably makes equities so profitable at times, because you have these sudden moves higher, but it also can be remarkably painful, right? Because if you're caught on the wrong side of something like this, it can hurt in a big way, right? If you're short Starbucks, feeling pretty good until today, you're completely underwater and probably have to cover at a pretty big loss. That doesn't feel particularly good. That one-off, those sort of company-specific risk items, news risk is what I would probably call it, is very real. I don't think charts are not helpful. I think charts are always helpful in terms of helping you understand once the market opens, you see how the valuation has reset. Once the market closes, you can tell that there's either a lot of short covering, which is probably at least part of this, accumulation. There's a lot of optimism about the new CEO and what that might mean for the company. Can that turn around this chart, which has been an absolute dog for the last year and a half? I think that's a very fair question. So I think charts are very helpful around earnings, around big news events. While it can be difficult to predict this sort of gap, it does then give you something to work with. All right, now we have this new frame of reference from around 90 to 95. We have that initial day's range, and now we can start to think about what additional data do we get tomorrow, Thursday, Friday, and what does that tell us about additional signs of accumulation or lack of accumulation? Do we see people selling out once the news has been kind of digested? That's where I think charts can be quite helpful. And think about this new information that we've gathered. This is the market giving us additional data. Think about how today's gap lines up with previous levels, what sort of support and resistance we may want to think about. What would tell us that the trend is going to change yet again? I do want to look at the chart of Meta, because this is one out of the Magnificent Seven and Friends. I would say this is the, obviously the closest to making a new 52-week high. Meta is right back up at the upper end of this range, and I have a line down here sort of indicating support. I'm going to make a duplicate of that line and pop it up here, just kind of loosely indicate some of this. I actually don't like that. I'm going to make it more of a rectangle, just to show this range, because I think of it more in a range. Support and resistance levels, I think of them less as levels and more ranges. That has served me very well, generally speaking. So I'm going to do that. We're going to delete this guy. There we go. So now I kind of have, I can see how we've basically found support at that gap from late January, early February. We can see how that has served as support a number of times. That's around 450. The 200-day moving average, for the record, not too far below that level as of now. But we can also see resistance that has occurred. The high in April, almost the high in March, but really the high in April, the high in July, now these subsequent highs and where we're at this week, all right around that same level. I think a chart like this that's sort of in an equilibrium state, right, from end of January to now mid-August, we really haven't gone anywhere. We've been noisy, but sideways, right? The primary direction is sideways. You wait to see which way we break, which comes first, a break above 540, getting us out of the range to the upside, or a break below 450, getting us out of the range to the downside. Arguably, whichever way we break out of that range, that's the next move. That's the direction of primary momentum, and I would argue something to follow. So keep an eye on Meta as well. Folks, that's it for the show today. Thanks so much for joining us every weekday after the close. For Stockcharts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.